and gentlemen, we got some more bank earnings with the Royal Bank and, of course, the National Bank of Canada. As we're going to just brief over those financial results, as well as many of you pointing out, why buy a bank stock that yields 4% when you can buy a GIC, a guaranteed investment return, that guarantees 4% with no volatility in a stock price. Damn it, we're going to be talking about that because I'm going to be utilizing that within my portfolio. Then finally, I want to update you on some fun statistics coming out of the Canadian real estate market, because so many of you think the real estate market is going to get slaughtered as interest rates go up, which is going to deteriorate these banks, and we're going to see further recessionary and depressionary periods in the market. But I'm going to try and offer a little bit of opinions on all of this. So if that's a conversation you can appreciate, in return, slap that like button for me, baby. Let's get right into this, folks. First and foremost, Royal Bank. This guy's paying out 4.1% right now, guys, trading down 3%, kind of following suit with Bank of Nova Scotia's earnings yesterday. And Royal Bank, I think by far is going to be one of the hardest hit banks we've seen. I'm actually kind of shocked by how bad these earnings were. Their net income was down 17% year over year. Diluted EPS is down 15% year over year. Everything at the top line is just basically down. But let's take a look, because like Bank of Nova Scotia, I want to fixate on the revenues, because so long as revenues keep growing, I'm usually pretty happy, because usually there's loan loss provisions, write-downs, whatever, other things that come into play from an operational standpoint that eat into those revenues and that bottom line net income. But take a look at this, 12.75 billion this time last year. This quarter, they did 12.1 billion. So their total revenues have decreased, not in a good way. I mean, that's not fun, because considering personal and commercial banking saw a decrease over last year. They did 2.1 billion last year, 2 billion this year. Wealth management actually saw a little bit of an increase. Insurances decreased. Investor and treasury services actually increased, but very incrementally. It's a small portion of their revenues. Capital markets decreased dramatically from this time last year, only doing 479 million versus 1.1 billion this time last year, which is crazy, right? So that net income is down pretty dramatically here at 3.5 billion versus 4.2 billion. Yeah, 4.3 billion this time last year, folks. So that's just a briefing. I don't want to bore you too much with these numbers. So let's take a look at the National Bank of Canada. Came in as a breath of fresh air. Keep in mind, this bank is much, much smaller. I find the littler banks are doing a better job at actually growing, because take a look at the 5-year chart on this, up 66% versus Royal Bank, that's only up 31%. So this one's doubling the performance of the largest bank in Canada, also paying around a 4% yield. And taking a look, guys, their net income was down slightly from 839 million to 826 million. However, they managed to make it so their diluted EPS was only down 1 penny. So people were pretty glad to see that they kind of came in line with their earnings estimate, I guess. But their payout ratio, and all the banks' payout ratios, are usually fairly low at 34%. I like that they put that right at the top of this page. But taking a look at the revenues again, going from 2.25 billion to this year at 2.4 billion. So this bank crushing it, like absolutely doing phenomenal here. So I mean, from a revenue standpoint, I'm not complaining. I dug through this briefly. I saw that they said the same thing Bank of Nova Scotia did, that, hey guys, people are still depositing a lot of money into savings accounts. We're seeing increases there. And then on top of that, you know, Bank of Nova Scotia at the beginning of the year said, hey, as interest rates go up, people get skittish. They're careful with loans and mortgages. So we might see a slowdown. But as those interest rates nominalize and people adjust to them in the following year, we should see an actual revenue growth increase, because now people are paying more in interest, right? But taking a look, for those of you that don't want to deal with the volatility of trying to pick the best banks, somebody pointed out a really good BMO equal weight bank index ETF focused on these Canadian banks. Again, the performance is very nominal here, but it's stabilized for those of you looking for a really nice 4% dividend yield and a really low expense ratio, because this basically holds all the top Canadian banks. There's 1, 2, 3, 4, 5, 6. They own 6 of the Canadian banks, which isn't very diversified, but it's just a really easy way to bucket them all together really, really quickly, right? Without having to buy them individually, worry about what one you should overweight and underweight. They kind of do the work for you. I just wanted to point this out. I don't personally own this. It's a little bit concentrated for me, but for some of you out there that might just want income from stable banks, you're only paying about a 0.28% expense ratio, get about a 4% yield. And again, guys, it's funny to see that the top weighted bank in here is National Bank. So I don't know how they came to that conclusion, with Royal Bank second in line. Again, very equal weighted balance. But nonetheless, folks, let's talk about these G to the I to the C's, these guaranteed investment certificates. And I'm going to be waiting, because I'm going to give you a little bit of a strategy of how I'm using my emergency fund to divvy up between all these different GICs, because I think there's a real fun strategy behind this to make a really healthy yield that is well beyond the basic banking yield that I'm getting right now at 2.2% of my savings account. However, if we're still in an interest raising environment, I want to see how it affects these GICs, because maybe they do go up on the interest raises. But see this, the next scheduled date for announcing the overnight rate target is September 7th, 2022. And this is from the bank, the Treasury here in Canada. So I'm going to be paying close attention to just seeing what the next rate hike is and seeing how that affects these savings rates in these savings accounts and these GICs before I do anything too drastic here. Because obviously when you put money in a GIC, you're kind of locking it up at a fixed rate. But taking a look, guys, you can get cashable GICs. A lot of people think these are locked up permanently, but there are a lot of variable GICs that basically allow you to park money at a really high rate. And if you need it after 30 days, you can draw against it without any penalties. That's what we have here with this first level of, guaranteed investment return. It's a 1 year where you get a full 3% after the year, but after 30 days, if you need the money, you can pull it out without getting any penalties, and you still collect a little bit of interest, right? So you can see cashable after 30 days, no interest penalty. So this is the kind of the first level, the safest level, and that is much higher than most savings accounts, which is incredible because my high interest savings account's about 2.2% right now. So I could inch out another 0.8% on the bit of emergency fund I have. Now they do have promotional rates. Every bank is different, and to be honest, I'm finding Scotiabank has some of the best rates right now because on a 1 year you can get 3.88%, but keep in mind these are non-cashable, so you're kind of locking it in there for the full extended period. So 1 year, you better hope you don't need it within the year, but it gets better. It gets better here, folks. Going into the basic rates they have for 14-month, you get 4.4%, which is kind of confusing because you can see that on a 3-year, you get 4.65%, but on a 4-year, you get 3.88%. So why would you go with a 4-year? I don't know. But nonetheless, I would probably, what I want to do here is basically I want $10,000 in an immediate accessible high interest savings account. That's for basic emergencies. If I need it tomorrow, it's there. I'd like to lock up maybe another $10,000 at 3% on the 1 year, but I'd also like to take advantage of these higher rates. And that way throughout the year, if I ever need money for an emergency, there's constant liquidity in that emergency fund while I'm also getting the maximum dividend possible. Now, this is a really intriguing option over buying banks. And again, this hasn't existed. I mean, go back a year ago and GICs were only paying 1%. I want you to keep that in mind. We're in a whole new market here, folks. So these are very fun tools to take advantage from that I think would really help somebody. And I think primarily focused with an emergency fund in mind, right? So let's talk about mortgages here, baby. Let's switch over to the real estate market real briefly because I find this utterly fascinating. The typical mortgage payment could be 30% higher in 5 years. Now, why 5 years? Because most people have fixed mortgages where they don't see interest increases for 5 years, but they have this fascinating chart. And this could be interpreted in very many ways, but take this into consideration that 37% of Canadians are renting, right? 28% of Canadians own their own home. So 28% of the entire real estate market is cushion, which is incredible to think about, right? I mean, that's a huge percentage of homes that aren't dealing, with the interest rate bringing down the bank. A lot of people seem to think after these mortgage rates go up, the bank is going to get slaughtered and people are going to start defaulting like crazy. But there's a huge cushion of 28% of the real estate market not held by banks. They're purely owned, which is incredible. So 35% of homes are mortgaged, right? Which is neat to think about because 25% of them are fixed rate loans, which means these are the rates that are locked in for 5, 10, or 15 years, probably at anywhere from 3 to 5%. So those people don't really have to worry until those interest rates come up for renewal, and then they'll be at the new higher rate. And that's why everyone's kind of freaking out about what happens in 5 years. But honestly, in 5 years, the bank could lower the interest rate as well. So it's all speculative by nature, right? Now, the scary ones are the variable rate loans, which make up 10% of the market. With variable rates, if those are only locked in for a year or they're purely fixed off what the rates are doing in the market, you usually get the lowest rate. But again, in an interest raising environment, it could fluctuate up, over a month, over a year. You're not really getting that locked in fixed rate. So honestly, it would seem as though about 10% of the entire real estate market is in perhaps some dangerous territory for people that could see interest rates go up. But this is a good sign, in my opinion, that the housing market should stabilize and shouldn't affect the banks or those mortgage rates or defaults from the banks in any material way unless interest skyrockets and doesn't come down in the next 5 years when a lot of people's fixed rates might be coming up for renewal, right? So this is a fun way to think about it. And again, this is thinking about people that probably bought a house sometime within the last 6 to 12 months. Those people are the ones that are really getting impacted the hardest by what's going on in the real estate market correcting. I mean, they're the ones seeing the massive declines, the raising interest rates, the higher monthly payment. Those are the guys getting hit. But anyone that's been in the market for 5 years or 3 years or longer, whatever, they're probably doing just fine. So I just wanted to take this into consideration that I just don't think the banks, this is why I love Canadian banks, right? Because largely, I just don't see them getting much more destroyed than we're currently seeing. I mean, Royal Bank's probably the worst numbers I think we're going to see. We got Canadian Imperial Bank, which will give us real insight into mortgages tomorrow. They have a huge percentage of their entire loans through basically retail housing or the general housing market for people that are just looking for houses to live in with families, etc., stuff like that. They're less commercial based, which I find very intriguing. So you take those earnings out tomorrow. Maybe I'll mention them, but I want to pass the question off to you. I'd love to know what you guys think about all of this in that comment section below. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.